234. Can everybody hear me? 234, 234. Checking. Test. This can get kind of obnoxious. Sorry about that. Let's see if anybody can hear me. There we go. Got a listener. If you could do me a favor and hit an emoji if you can hear me out there. It's hard to tell. Can you give me a thumbs up if you can hear me? 2, 3, 4, 5, 6, 7, 8, 9, 10. Can everybody hear me? Well, hopefully you can hear me. It's hard to tell whether you can or not. There we go. See if we can get this thing rolling. Oh, good. Glad. Thank you, guys. Appreciate it. I know that can get obnoxious. Welcome, everyone, to Truflation Space's pre-BLS CPI print edition for Tuesday, August 13th, 2024. We're featuring Henrik Zeberg. He's the head of macro out at Swissblock and an Elliott wave chartist. And he keeps a lot of his work archived out at the ZebergReport.com. That's all one word, TheZeberg report.com. And we're very lucky to have him today because, man, what a week and what a month it's been. If you've been paying any attention at all, it seems like there's just one headline after the other. Obviously, there's the carry trade contagion from Japan that's sunk pretty much everybody's portfolio, at least for a little while. We've got, I'm laughing because it's gallows humor. I don't mean to make light of it, but there's wars going on, of course, in Ukraine and Gaza, which could affect supply, above even the human toll. And of course, we've got a presidential election that's heating up. So you might have heard last night, the head of X, Elon Musk, had a chat. I think a 2-hour chat with former President Trump, and among their conversation, the part that we kind of zeroed in on, as you might expect, was their talk about and. Very interesting because Trump wanted to kind of keep going back to oil and saying that was the cause. And Elon very delicately, very, very artfully and diplomatically kept back to the classical definition, which I guess now, which was news to me. I always thought it was kind of obvious, but of course, I live in an echo chamber. Elon kept saying, no, don't overcomplicate it. Inflation is really caused by government spending, and it's a government program, and a policy really. And if you think about it, it makes a little bit of sense, at least logically, if you're not emotionally in one way or the other. But it's essentially what Elon was saying, which we found really beautiful and terse, and it took 30 seconds to, there are just gigantic books and papers on the subject. And Elon said, no, what it is government prints more money. It's an increase in the money supply, and therefore we have more of these paper tickets, or in this case, digital, chasing fewer goods, and prices rise. Inflation is a consequence. Prices are going up as a consequence of government action. So that was really interesting to hear. Basically, depending on how many people listened, something like 2 million people being red pilled, and hopefully that'll bring them. They'll start their conversation, start the rabbit hole to thinking more about inflation and thinking deeply about it, and uh, get them here to Truflation, which brings us to our really, I think, why a lot of people tune in. Monthly, we do an inflation report, which is really highly anticipated. It's one of those leading, lagging indicators. At the same time, we all the relevant information out there and distill it down into a beautiful report that's charty and mathy, a nice narrative for you. And we of course go through it here live a little bit for you, give you a taste, and then we publish it, and you can get that just today. So you're in for again, if you're just joining us, it's Spaces pre-BLS CPI print edition, and we're featuring um, Henrik Zeberg. We're trying to get him online here. He is the head of Macrod at Swissblock, and he's an Elliott wave chartist. All of his work is archived out at the Zeberg report. It's all one word, THEEBERG report.com, and he'll be up in just a minute. We have, of course, assembled our usual. That's the Truflation guys, our CEO, Stefan Rust, our head of data, Oliver Rust, and of course, and our head of data, Ivan Yelich. So you're in for a treat. Hopefully, you'll enjoy the spaces, and let's get right into it. CEO Stefan Rust. He usually gives us a breakdown of where the company is and all things Truflation Nation. Hey, Stefan, we appreciate you taking some time out here to join us on Spaces. What's the state of the Truflation Nation?
Yeah, thank you. Thanks everybody for being here and taking the time out to the anticipated BLS CPI report. And thanks, Henrik, for joining in and sharing his insights from a macro perspective. Yeah, Truflation Nation. I mean, the world is going through a big change. I think we are all trying to deal with that change, and everybody's looking for an alternative source of truth. And I think that's what Truflation tries to provide: transparent, immutable, censorship resistant, and just make that available. So just more and more we are seeing the need for having this alternative source of truth. And we're really excited to have innovated in tracking housing inflation in a very different manner. And we will be publishing a huge report today with Penn State University, with whom we've been working on solidifying our new methodology that Oliver and Ivan have been working on. And that we're excited about that. We've got a really interesting announcement on Thursday. And obviously the report, I won't share too much thunder and leave that to Oliver, but you came here to hear more about the CPI and the economic situation, not from me, but from the experts. So I'll hand it over back to you, Rourke, and let's let the right speakers come in and share their insights. And everybody can come in and listen to the Truflation Nation at 12 p.m. later today as well to get more update on Truflation.
Yeah, a huge week and a very busy one for us, as Stefan outlined for this at p.m. Eastern, a couple hours after. We've got our usual Tuesday live stream where, again, Stefan will kind of give you some more insight into a lab with Penn State. There's a white paper that's coming out, all sorts of interesting stuff. I don't want to get too far ahead of him. It's a nice segue to turn to head of data and to ask him a little bit about we're at the forefront of putting all of our indices together. We've got a whole bunch of things out there, whether it's a bit um, 50 T index, all sorts of great stuff. Ivan, thanks so much for coming back on. I noticed today the UK inflation rate it bounced up from the two teens to about 240. What's your general take on inflation and things that are out at the site?
Hi, great to be again. Actually, great that we have this cadence of monthly, but sometimes during the FOMC meetings, even more frequent to give the update. As Stefan mentioned, we have a huge one coming today, but also on Thursday. New index is coming out live. Won't tell too much. We'll leave it to our magicians and marketing team to tell a better story. On the other hand, actually on my way to Toronto to attend the Blockchain Futurists Conference, where Truflation is at one of the panels. So looking forward to that, to meet the Canadian community. But also, as you mentioned, in UK, we've seen some uptick in the overall number, which comes basically is caused by the increase in prices of some of the goods, mostly the ones the furniture and the ones in household items. So the uptick was, when you put it in that scale, quite significant. But also when you look what has been happening within last 12 to 18 months in UK, the change is not that big. So things are starting to stabilize. Before we had few percentage of changes within a week. Now it's much more stable in UK, which is good, but it's not still at levels that we would like all to see the inflation in both UK and US. But it is what it is, and let's see what happens next.
Yeah, yeah. It's really interesting to watch that number dance. And a lot of people have asked what the difference is, or they're constantly asking us what the difference is between, say, Truflation's daily CPI and the BLS, sort of the government CPI report that comes out monthly. Well, right away, you've got that distinction. But also, I think over the last couple of years, we're trying to figure out what those numbers mean. And it's never been done before. So to see it move up or down, we're with you guys. We're also trying to figure it out and make sense of those numbers. So it's fascinating. At the very least, it's something you should have in your arsenal and your quiver. As part of your portfolio analysis to kind of check Truflation. And it's becoming a don't walk the block, the single block without it. We're usually, I guess, a leading indicator. Depending on who you talk to, which analysis you talk to, we're about 6 months ahead of the market, and we've been pretty good, spot on, since our inception a few years back. So, again, this Truflation Space is, of course, brought to you by Truflation.com. Get out there, so many fun indexes. Just the EV one, we just recently printed a report, a free research report on the electric vehicle industry. Super interesting. Again, it's free. And what you'll notice about our index, our EV index, is, well, first off, it's sexy. I mean, it's, if you like charts, it's beautiful and it's interactive, so you can kind of monkey with it a little bit. But it's also priced not just in USD, but also in Bitcoin, which is, no one's doing that. And so it gives you a really interesting take on perhaps maybe the future of money. So again, get out to Truflation.com and check that out. We think, again, if it's not going to be your go-to, your main source, it's you have to have it in your basket of data. That leads us, of course, to the reason why a lot of people show up to these spaces once a month, and that's our monthly inflation report brought to you by our head of product, Oliver Roost. He is a man in heavy demand. He's all over the place on podcasts everywhere, and he puts together these amazing reports that are fun to read. They're super insightful, and let me just brag on him a little bit. Last month, he nailed it. I mean, down to the point oh inflation prediction. I don't want to jinx it too much, but thanks so much, Oliver, for coming back on, and congratulations, man, on really nailing it last month.
Thanks a lot. I mean, that's just the modeling work, but I think the difference lies in the data sets that we have that makes it easier to predict the trend lines and where it's going and how it's heading.
Yeah, yeah. Well, you've got your job cut out for you today. A lot of people want to know what the heck is going on or has been going on. We've got carry trade contagion. We've got wars. We've got a presidential election. Give us kind of your take on where we're headed, or what you see, and a little bit of alpha for that inflation report, which we will print right after Spaces.
Yeah, so I think I think you're right. I thought I would not be saying these words again for a while, but obviously not. And these words are this inflation report, and I think the next inflation report will be critical for the Fed to make its decision on its Fed rate cuts on the September 16th and 17th during the September meeting. And the data that's going to come from now to then. You're going to have two CPI reports. You're going to have a PCE report. You're going to have unemployment reports. So there's a vast amount of data that's going to be food for thought for the Fed and what they decide to do with regards to rates. But of course, there's also the Truflation data, which is getting updated daily, and they should also give people indication of where the CPI numbers are going. As for the month of July, look, I think there's been a bit of a mixed reactions. I think the markets are expecting inflation to hold at 3% year on year. So that's the same as the June number. I think we are certainly seeing the drops in prices of goods. We're seeing the drop in non-core. And I think coupled with all that, we're also seeing some supply chain constraints, oil prices, the geopolitical tensions continuing to be key concerns on the inflation number. So before I go into the inflation itself, I think, we look at, let's say we look at the unemployment numbers, and, I think everyone saw the employment numbers that were released by the BLS for the month of June. And, they certainly were, they've increased quite a lot. There's a lot of talk about the SARM rule and, where that's progressing and how that's going to change. And are we in a recession or not? Don't want to necessarily talk about that. But I do think that the softening of the labor market should have an impact on the prices of services. I think not only are you looking at unemployment rate, you also got to look at wage increases. And the rate of wage increases has been cooling, but very marginally. And that should we believe will keep the prices of services a bit more elevated than what we had anticipated a couple of months ago. They'll still cool down a bit, but it won't cool down dramatically. I think the other thing then beyond unemployment, of course, is consumer spending. And, retail sales and consumer spending numbers that are released by the Bureau of Economic Analysis and the BLS have shown strong growth in the second quarter. You're looking at a 2.3% growth of personal spending and a 5.2% growth on retail sales. So significant growth in the second quarter. And that's certainly keeping the U.S. economy continuing to grow. The second quarter two numbers came out at 2.8, although I think the second and third revisions of that will bring that number down to somewhere about 2.5 and 2.4, partly because of the sizable inventory build that they had adjusted for in those numbers. But it does go to show that the U.S. consumers are still more resilient than ever. But I do think, if you look at that number a bit more detailed, that there is a bit of concern that's starting to emerge, which is the delinquency rates on credit cards and the credit card debts and delinquency rates are certainly continuing to rise. So it's certainly something to keep an eye on and what that will happen on consumer expenditure and demand for the future growth. Having said all that, I think for us, we're certainly expecting inflation to continue to cool this month. We are seeing the three categories that are applying downward pressure on inflation. One is the food category. Obviously, they're seeing significant reductions in lower commodity prices and reduced labor costs, which will lower the prices of food. Dining out is also seeing a much more softening of the prices of dining out. So that's going to be a significant contributor. Given the weight contribution that food has, it will be a significant driver. So the other categories that we're starting to see some significant decline on are other goods categories, things like clothing, things like raft of other goods categories, household goods, and so forth. And I think that's a lot to do with the inventory management. I think a lot of these manufacturers and business owners are looking to bring equilibrium back into the inventory management supply chain systems. And that equilibrium will then allow these organizations to marginally start increasing prices and not having to offer significant discounts to remove their inventories, which has been plaguing the industry for quite some time. So, and then you have the other factor that's going on, which is the housing market. Obviously we see rented going up, but the way we measure housing, the way Truflation measures it, which is different to the way the BLS does it, we see that the owned property market is coming down. And it's coming down. So it's not to say that housing prices are coming down. The housing prices are going up. But from a consumer standpoint of view, as the interest rates and new mortgages are taken out, comparatively the cost of mortgages is coming down with new mortgages issued at a lower interest rates. So it's certainly some exciting times. The big concern again in the housing market is the supply. And I think somewhere there is a lack of supply in the housing market. So if you look at unsold existing home inventories up at 4.1 month supply, that number needs to be somewhere up at about 6 months to start getting some real equilibrium in the prices. And the concern that we have is as interest rates come down, thus in turn the 30-year fixed comes down, you'll start to see a surge in pent-up demand for new properties. And that will most likely drive up prices again further. So that's more in the longer term, not now. But if you take all those factors into play and what's causing the downward pressures on inflation from a sector point of view, I think we're looking at inflation coming in significantly lower than market forecasts. We're expecting it to come in at 2.85. So it should be quite an interesting forecast in a month ahead. And then what happens in the next month will probably give us more food for thought of what the Fed will be looking at doing in their meeting in September.
And so is the prediction that the BLS will match you, and your thoughts there, and come in around 2.85?
That's certainly what we would expect that the number to come in, whether it's 2.9 or 2.8. We're right in that middle of that cusp. So, you play around with those numbers a bit. Variabilities here and there, the delay in the BLS numbers and how they collect the data, the impact of housing. I think they will come down. They have to come down for a number of reasons. But, I think at the end of the day, it's a question of how they see how it comes up. And, that's our forecast. We've been pretty spot on for the last 3 months in a row. We have generally a pretty strong prediction in the longer term quarterly forecast that we do. And again, we're spot on target for the quarterly forecast as well. So, the proof is in the pudding, as they say, but we certainly expect the BLS numbers to come down. And I think if you look at it on a month-on-month perspective, I think the market's expecting a 0.2% increase month-on-month, and we're expecting a significantly lower increase than that to get to the 2.85 that we have versus the market at 0.2 increase month-on-month to get to a 3%. And if it is a 0.2% increase as the market is predicting, that would actually mean a month-on-month would see an increase in inflation versus the previous months where the BLS reported as flat. So that means it's going the other way again. And I think that would really cause some concerns for the market and also for the Fed. So any data that we're looking at, we see the trends going down and not re-accelerating yet. Although we do believe it will re-accelerate for a number of reasons: the housing, the premiums, the insurance premiums. You got the supply chain issues. You got the geopolitical concerns, and you've also got the massive capital surge of liquidity that's coming to the market as a result of the debt relief that's been awarded. And so, all these factors coming together does have a more of a longer term question mark of whether the inflation really is under control.
Yeah, as you were talking, I was thinking back to January of this year when a lot of analysts were suggesting we're going to get something like 3 rate cuts this year. I'll be happy. Interesting analysis. All that was our head, Oliver Roost, with the report. We right after Spaces will provide on X. You can get out there and get your hand. Oliver also have the white glove treatment. If you sign up for Truflation, there's something for everybody. There's some low. I think we offer like $19.99. If you pay in crypto, it can get as low as like 12 or 14 bucks or something crazy, all the way up to a Bloomberg, decentralized Bloomberg experience there behind the kind of take you through it. He's an expert, and someone to lean on. Already guest, you're listening to Spaces pre-CPI edition. Have a terrific for you today. That is Henrik Zeberg of Swiss Block. He's the head of macro and an Elliott wave chartist there. He keeps his most of his stuff archived out at the zebergreport.com. That's all one word, THEZEBERG report.com. Wow, what a time to have you on, Henrik. Thank you so much for coming. Appreciate it.
Thank you very much, and thank you for inviting me on today.
Yeah, so just Oliver, you've got your work cut out for you. What a time. The world is on fire, my friend, and a lot of people talking about economics. They're talking about inflation. You seem to have a toe in both the legacy kind of TradFi world and precious metals and also crypto. So tell us kind of take on what you've heard and your thinking right now in mid 2024.
Well, first of all, I want to say why I'm a huge fan of the work that you guys do, because you just what Oliver just took us through here, the level of details and the way you go about this is just fantastic, and I think it's a breath of fresh air for everybody to get what is almost real time data for inflation instead of these lagging numbers that we get from official sources. So thank you for that. What do I see? I mean, I see a lot of things also that Oliver was talking about in terms of downward pressure on inflation for now, and I'm happy to hear also that you have an estimate now that it seems lower than the expectation of the market is. That's also what I see. But I think I differ somewhat on what is maybe coming ahead, and that has to do also with the outlooks that Oliver was pointing to in terms of the labor market and the things that could be driving inflation lower. So, but in terms of the short-term pressure downwards here, I think that is spot on. But I absolutely do not have the kind of details that you guys have, and that's why I, often turn into your page also to take a look and seeing your estimates on things here. In terms of what drives this now, I think we've seen the top in the business cycle. So I do a lot of business cycle work, and this comes from data from the conference board. And what we see there is that we have, very clearly a top in the business cycle. We're starting to see the coincident indicators, as they're called, rolling over. That means that we have the leading indicators that have rolled over and for a long time have been telling us that something bad is coming. And everybody seems to have forgotten about this, that we have a yield inversion, and we have had that for the longest time. We have had, I think it's more than 700 days now. And people just kind of, shoving that away and say, well, maybe that's not, something, not a reliable indicator any longer or something like that. I think it's a very reliable indicator. And this is actually one of the leading indicators that I follow together with a composite of others. And what we can see is that there is definitely something about this, what we get from this yield inversion. And if that's correct, and what we now see, the weakening in the coincident indicators, which are the indicators or the economic numbers that follows GDP, well, then we're in for a big decline in the economic activity and actually an outright recession. And I even think it's going to be a big recession. And that's why I think what we're looking at you can see the short-term figures here will be based on what the downward pressure that we see that we already have, from the Fed hikes and the likes. But if I'm correct on the recession setting in by end of this year, well, then you're going to see a lot of downward pressure. And I think we could also end up in a situation where we get outright deflation. Actually, that is my forecast. So I think it's about the economy first and about the consumer. And as Oliver also rightly pointed to, said, well, the credit card delinquencies are starting to move up. Yes, actually they are, and they're moving up with the same kind of rate that we saw into the financial crisis. If you look at anything that has to do with the consumer, if you look at what is normally driving the business cycle, or always is driving the business cycle, then it's the interest rate, the personal interest payments. So we know it from when we have a mortgage loan or we have any kind of debt, we see that the interest rates start to move up, and then we have to pay more in interest payments every month or on a yearly basis. And that slowly starts to put a pressure on our personal economies, and that's why we will have to cut spending. And that is what we see now. That is the process we're seeing now. That's also why you see
advanced sale, retail sales flatlining, and that is not what you want to see at this point here. So if we were at the beginning of a new business cycle that a lot of analysts and economists seem to claim, well, then we should not see this. Then we should see actually the quite opposite. And with the level we have right now of interest payments as part of disposable income, I do not see any soft landing anywhere. I think it's a narrative that has been put upon us, but it has no root in the real economy. And I think if everybody, we are all consumers, we just look at ourselves. We are actually spending more money on interest payments. We still have inflationary pressures, and you also know more about this than I do, from what we saw into Corona or after Corona from the stimulus that came out there with the inflation pressure that brought about. So I think we are talking ourselves into the same kind of situation that we had into 2007, where everybody also kind of thought that, okay, now we're seeing the light at the end of the tunnel because inflation was coming down. At that time, inflation was also rather high, and yields were coming down as well. And actually what we saw, the light at the end of the tunnel was not daylight, that was the recession train coming right at us. And I think that is exactly what we see this time again. So I think you will have a lot of downward pressure on inflation. I think we're going to see that it'll be the business cycle, it'll be unemployment rising very fast. And we're already seeing that negative deflation area, the negative spiral, I would call it, from the unemployment moving up, which is, the real driver of the economy. So I think I have a little, somewhat different, but, again, similar to you, at least on the short term.
So Henrik, that's super interesting to also have a different perspective, right? I mean, that's why we like these conversations. But I think one of the things is, do you think that had Powell or the FOMC reduced interest rates back in, earlier this month, that would have had a better impact and would have softened the landing? Or, it would have been still too little too late, no matter what they do?
I think it's too little, way, way too late. And I think that you can go back all the way to 2008 when the whole QE thing started that has been bringing about this inflation monster that we're now starting to see the beginning of, even though it's going to move into a deflationary phase. But I think the real problem that was created by the central banks around the world and the administrations from around the world was into the COVID crisis, or the COVID pandemic, where they started to stimulate demand into a supply crisis. That is so misunderstood. So people were going home. Just think about it. People were going home because they couldn't meet in at work, and then they boosted demand through throwing fiscal and monetary stimulus at us. So of course, and you know that better also than I do, prices are not moving up immediately. There is a certain lag to it. Of course, first you'll see that the shops and whatever you have, warehouses, will be selling out what they have on their stockpiles. But as they start to feel shortages because of the increased demand, 25% up or whatever it was, and we have to remember that the amount of stimulus that came out after COVID by far beat what we saw after the Second World War with the Marshall Aid, which was supposed to build up entire Europe. So I think this kind of stimulus into a supply crisis created that absolutely inevitable inflation spike that we saw. And then now you see the Fed. Oh, what is it? We let the genie out the bottle on inflation, and now they got spooked by that, and now they've kept it on for too long. So they are simply too late, and way, way too late this time around. And with the kind of deflationary force that I see coming against us here because of the real economy, and let me just elaborate on that. What we had into Corona was that when everybody was starting to spend that stimulus money, you saw businesses, moving up or having, the fantastic sales. A lot of the companies around the world had that. You saw how they had to boost capacities because they say, well, we're 130 on index 130. We do fantastic. We do a great job. So why don't we invest and expand? See, that is in the short term a good thing, unless we start to see demand coming down again because of artificial demand. And that is what we see. So now you have a surplus, a capacity bigger than it was supposed to be due to that kind of, misunderstood stimulus. And then you will see that demand is coming down, and now the companies, the organizations of the world will start to cut the capacities, the surplus capacities they have, and that is by all definition the very, that is deflation. That will cause deflation or deflationary pressure. So I think this is the driver of what we see. So even if the Fed came out last month, they have no way of micromanaging this. And also, as you will also probably be able to tell me better, there is a lag from the monetary stimulus that they provide to us until the moment that people start to say, oh, we actually spent this. We have to remember that when the Fed lowers rate and it comes into our account through lower payments on our loans and the mortgages that we have and so on, well, we have a choice. Do we go out and spend that money immediately? Or do we keep it in our pocket for a little while to weather or to gauge, where do we stand economically? And I'm saying here that we are standing at a point where I think a lot of people has been hit by inflation and by interest rate spikes. That even if the Fed did come out and did this earlier, I think a lot of people think twice and say maybe we should just keep this extra money in our pocket for a little while just to see what's going on. And that is exactly what makes the monetary stimulus impotent. And that is why there'll be an even bigger lag when they start doing this. So they are hopelessly behind the curve. And the curve is not just a fixed thing. That the curve is defined by the behavior of the consumer. And that is what I think the Fed is missing big time this time around.
Yeah, I mean, that's largely the reason why we actually went out and set up Truflation was during COVID when they printed that amount of money and told us that, oh, inflation is only transitory. We just couldn't believe that. And so as a result, we just felt we needed to innovate and provide high frequency, real time, census-based data sets. And that's sort of what led us to Truflation today. But I think on that note, I think there are two concerns that I have really, right? We see more bankruptcy filings, so more companies actually filing to, especially small, medium businesses struggling with obtaining capital and being able to invest and continue to compete in building businesses and hiring people. Hence, unemployment rate is growing, up and up. And then on the flip side, to your deflationary point, how do you see that? I really, keen to learn that, because what we're seeing is there's a bigger demand to onshore product. And if I'm onshoring, I don't get, or nearshoring, I'm not getting economies of scale anymore that we have today in the market, where we have big manufacturing, they can bring down unit costs and they can ship it around the world. Although shipping costs have been going up, but ultimately, how does that, and then the time lag it takes to then nearshore, build out factories, and then be able to have the same kind of product available at a cost that we're used to, how does that sort of compute with the deflationary anticipations that you have and you see for next year?
But I think you're describing the coming problem after what I'm seeing here. Things are moving in cycles. So I think what you're talking about there will be the next phase of it. That's why I've also been talking about a potential stagflationary phase developing after deflation. And I mean, this can be kind of little, maybe a little too technical or detailed, but when first of all, this will be about the consumer for a little while here, because the consumer now is hurt, and we talked about that, the credit card delinquencies and so on, and that they have not stopped spending, but cut spending, dramatically, is what is driving the more short-term pressures as I see it. So that's the downward pressure on prices, and that's also what we see in the CPI numbers that you get now. And the CPI number in my business cycle model is a lagging indicator on the economy, which means that CPI, inflation, and rates will follow the coincident indicators, which are the labor market, down or up for that matter. So I think what we're seeing now is the effect of what we saw 6 months ago. And that will drive the inflation pressure downwards for some time. What you're talking about there is something I think will happen in the next phase. Because let's be real about this. What is happening if I'm right on this and we get a recession by the end of the year, and I do really think we are going to get it and it's going to be bad. What will happen then? Of course, and everybody here on this show will say, But Henrik, the Fed will jump in, and then we'll party again. Well, I think that is exactly what they will do. They will jump right back in again, and they will try to stimulate demand. Yeah, just 1 second. They'll try to stimulate demand again. Yeah.
Yeah, no, totally agree. So they come to the savior again, right? So they come in and provide that golden handshake, right?
Yeah, but the thing is, if that's the case, or when that's the case, you're probably not going to see, first of all, that the consumers are going to go out and do that spending. And if they do, then you can have that rising price pressure that you're talking about because of the shifts that we may see going on a more global basis, on a geopolitical basis. So I think we will in for kind of a call a whipsaw, where we first will see deflation first we'll see prices coming down very sharply here. I expect them over the next coming months here into 25 to come down very sharply. And then you will see the opposite when that next phase starts to develop, and especially when the Fed moves in and potentially triggers what I think could be a stagflationary development at some point. So I think we it's more of the how it's going to happen, and what the sequence of this is going to be, in more than saying that the one or the other will dominate. Does it make sense?
You're listening.
Yeah, no, totally.
It's, go ahead.
Yeah, no, I like and I think you're right? I think with the consumer approach, and we've already seen it, right? So we're seeing delinquencies go up, et cetera. People are on holiday, but also the volume inside store sales has not picked up, and largely because the consumer is not accepting a price rise. From the revenue hasn't picked up because volumes dropped, but price rises haven't worked. And so they're getting smarter around using coupons, consolidating purchases and trying to scout for better deals, right? Versus actually accepting all these price rises that are coming everywhere. And so the consumer is still really driving. And as we know, 70% of the economy is consumer led. So,
and they will drive also in the future. If there's no purchasing power, you can set your prices at whatever level you want to, but the consumer simply will not be able to pay that price, and that's why by the end of the day it will be supply that has to adjust. And when that adjustment comes, that is the deflationary pressure that I'm talking about. That's when all the goods that are stored now and waiting for that demand to come in again will have to be sold off or getting written off. So I think we're not seeing this really yet, but it's coming, and it's coming exactly because of the things that you were mentioning here. And the higher the unemployment rate goes, and I think as I said, we've gone into that self-propelled kind of cycle now. The higher, the less likely the consumer will be to spend. And that's why we see it again moving higher and higher. So the Fed is hopelessly late, and focusing on the CPI number as one of their key mandates is simply looking out the rear window while driving forwards.
Wow. You're listening to Truflation Space's pre-BLS CPI edition. We've got the great Henrik Zeberg on with us, giving us a clinic here. He's the head of macro at Swissblock, and he archives a lot of his work out at
Henrik, thanks a lot for sharing that. I got a question for you. It'd be interesting getting your perspective. Is with regards to the impact of what you view on the impact of any rate cuts on inflation, right? You have the onshoring elements, you have the pent up housing supply, shortage of supply. It's been driving up housing prices going up. Not necessarily the impact on consumers, because of course in the US with 90% of the households buying on 30-year fixed. It'd be interesting to get your views on whether you see any reduction of interest rates and what the consequential impact would be on inflationary pressures. Do you have any views on that and what that outlook would look like?
Yeah, I think as I said, I think the inflationary pressures from what we see now with the business cycle rolling over, I think that will be, of course, that you are seeing interest rates are moving down, also. And I think actually we're going to go down to very, very low levels again. If I'm right, you're seeing actually a plunge into end of 25, beginning of 26. And of course, that can bring the housing market up again. But we have to understand also that if unemployment is starting to move up very strongly, then it might be that for some selected few that with a lot of money on their bank accounts, that they can go out and buy some an extra house or something. But the ordinary Mr. Jensen here in Denmark, or Mrs. Jones, or whatever they call, will not be able to, because they will be in fear, or maybe even having lost their jobs. So I think we need to understand this in a recessionary setup. This is not the same, and a lot of people don't even remember when we had the last real recession. I mean, it's 16 years ago, but I certainly do remember that, and I can tell you that if the unemployment rate moves up above, which I think it can easily do, 10%, well, then you would not see that pressure on housing, and I think you're going to get another downward pressure also on housing before we start to see it move up. I agree with you that when we get to the other side of this, and when we see the Fed coming back in again, well, then we're going to see inflation at a completely different levels over the next many years, also moving up actually also. But I think for now it will be the extreme. It's like a gigantic wave. It's like the consumers, as you said, the consumers are 70% of the U.S. economy. Just think about it. Across the world, consumption it will be declining because the consumer is right now hurting, and when they hurt, then you start to change the behavior of the consumer. So this about expecting that inflation will just spike up again, that is because we're expecting that the consumer will take that money that we save and start spending it immediately. Well, I don't think that's what we're going to see. And we have to remember it was a different setup when we had the corona crisis, because we also got fiscal stimulus here. Will we get that once again here? I think yes. I think we're going to see helicopter money can easily be seen if they're going to starve off this deflationary pressure that I see. So yield interest rates, yields are going to come down strongly into this phase here, but it'll be for a short time, I think. And then, as I said, I think we could see a stagflationary development coming after the Fed jumping back into the stimulus show, let's say mid-25.
Which totally speaks to your theory, Oliver, where you see inflation picking up again towards the second half, but then the economy totally stagnating, right, and not seeing any growth.
Yeah, I mean, that's certainly aligned with the viewpoints. I think the question is just when is that surge? When does the economy start to deflate, and when will you start seeing the surge? I think the other thing is, we also got to take into account all the stimulus packages that the U.S. government has been issuing through the Inflation Acts. When does that start to recede? Right, if it does. And I guess that's also connected to whoever wins at the election. But the level of how that recedes and when that starts to recede, whether that includes the incentives that were in plan in the past for the electric vehicle market, whether that's the food tickers that they've been distributing, all these inflationary acts, or even the onshoring you mentioned, Stefan, for the green energy and semiconductor businesses, when will that all start having an impact on an inflation? I guess is the question. But I think it will have an impact, and it will start to, whether that will impact demand, I think it will do, and I think the consumer will have a hit. It's just a question of to what degree and when.
Yeah, we would like to questions in here from our audience, possible. First off, kind of a mic check. Can everybody hear me okay? Can I get some thumbs up out? Me all right? Seems like the mic is being a little strange today. So
you were breaking in. You were breaking in and out, but yeah.
Good. All right. So.
Yeah. Sorry.
All good.
Is that better or not?
No. I'm talking.
Okay. Cool.
Okay. Okay. Sorry about that, guys. I know
about
it's obnoxious.
The short impact.
In my defense.
And when how far do we go before things, the onshoring, okay, you're obviously not hearing it, or it's breaking still in and out.
There's some denial of service attack taking place right now.
And in our defense, they happened to Elon, so there. Some listener questions here. We're getting to the back half. Got about 10 minutes left with the great Henrik Zeberg. If you haven't go out to com. That's all one EBERG report. All of this stuff is archived out there. And let's get some questions from our listeners here. First up is Deepak. Deepak, do you have a question for Henrik, sorry. Deepak, are you there? Okay. I'm going to go to...
Hello. Yep, Henrik. Truflation. Hi.
Yeah, hear you now.
Oh, yeah, go right ahead.
Go ahead.
Hi, Henrik. Been reading your tweets since October, September 2022. I was a bit reluctant at the time, but then, following and been a great work. Thank you. Thank you for all the help. My question is, given the scenarios that you have all just discussed, how do you see a CBDC set in and
Oh, did I get the entire Deepak? I think you're on mute again.
Yeah, I got on mute. So, Henrik, my question is on the CBDC. And then in this transition, what do you think would be the, I don't know if there is to say, best way to preserve wealth as we move through? It's kind of hard for me to, imagine all that. Thanks for helping on that. Thank you.
Sure. So first of all, central banks, digital currencies, that was what you talked about also there. I think, first of all, we need to focus on that. Of course, that's something that's going to come. And I know that the ECB is working on it. And I guess that the Fed is also. So that's something that's going to come up. How do we preserve wealth in this kind of environment? I think it's going to be more difficult than it's been for many years. And the reason is that you've always been in a world where you could kind of, focus on either in an inflationary kind of world or a deflationary kind of world. That means that you could have, risk on, 60% risk on in your portfolio, and then 40%, which could be bonds and the likes, and you could do well. I think in a world where we could see stagflation, that kind of portfolio could be a problem. So I would not say it's a problem right now. And as you probably also know, if you watch my tweets, I have a target on the S&P for 6,100 to 300, so around that, so like 20% from here. So into that phase, I think it's and again, it's not advice or recommendation, but I think it's risk on in the U.S. market. I have to say, I think the global markets, a lot of global markets have the top in around the world now. But after that, in the first part of this, in the deflationary part that we talked about here, then it will be the normal, setup. That'll be TLTs, bonds, short-term, long-term, depending on what your, risk profile is, and that will be the right setup there. It could also be long the dollar versus, any kind of currency. I think the dollar is going to strengthen a lot into that. I have a target of 120 on the Dixie for the dollar into the deflationary bust, because everybody will be needing dollars and not, anything of, like gold or silver or the likes. It will be, being able to pay off your debt or, these kind of things. That's what we see in a liquidity crisis and a credit crunch that I think we're going to see. But then after that, and this is where it becomes this whipsaw kind of thing, that if we're going to see this stagflation phase that I'm also, predicting here, then it'll be a completely different setup. And I think that is the real moment for gold and silver and gold miners and the likes. Commodity boom, I will say. It will be fantastic for any commodity around the world. But the problem is that, as you can hear, it's very, very difficult to navigate in, because if I'm right, you have something into October of this year, November maybe, for the top risk assets. Then you have something is a deflationary crash, and then you have something of a bounce, and then a stagflationary. It will be very difficult to navigate in, and that's what I'm fearing, and that's why I see that a lot of people, unfortunately, can get a little trapped in this whipsaw kind of effect we could see in the markets.
Great question. Next up is Rika. Rika, your question. Go right ahead. Rika, can you hear us? Well,
I guess not. I think one of the questions in the groups was asking about the impact of the Middle East and what we're seeing there. do you think will experience, that will have an impact on markets and inflation?
Yeah, obviously you could say that any kind of supply shock will always have an inflationary impact. But what we often see is that will often be countered by measures, and we saw also that with the Russian invasion of Ukraine, that we saw some countermeasures to the lack of gas or whatever it was, and now we see prices have been plummeting. So these kind of events are not the ones that sets the direction. These are the ones that can make a spike over a week or a month or a quarter or something like that, but it's not setting the direction of the economy. So I think, yes, obviously supply shocks can have these kind of impacts, but it will not change the direction, and it will not change by and large, it will not be what the ordinary person will be thinking about. They will be thinking about being able to pay their bills and be able to not lose their jobs. And these are the most important things. Obviously, if something then goes up in price, well, that will just put downward pressure on that as well. So it can have an impact, but on shorter time basis, not setting a new trend.
So where do you think, Henrik, from your perspective, right? I mean, we all want to protect ourselves against the downside, growing inflation, savings ain't going to cut it. Asset price inflation is always far greater than consumer price inflation. Where do you see, I mean, somebody's asking, Rutradia is asking about crypto and the blow off top of crypto before the recession. But more importantly, I think the bigger question is, where do you find, if you have investment capital available, and where would you lay that? Would you put it in commodities? Would you put it in oil? Would you be putting it into real estate or crypto? Where do you see sort of some of the areas that allows you to appreciate wealth whilst protecting against some of the downside if you have that spare capital available?
But again, then I think no matter no matter the strategy that we're trying to follow these days, we will see some kind of if you're just sticking to that strategy over the next, let's say, 2 years, you will see ups and downs there. So I don't think there'll be something that can just protect us, and that is the very the frustration of being in a situation where we potentially could see first a deflationary bust because of the economy rolling over. And if we are right on what we have this in discussion here, we could see then inflation moving back up again, and that will then cause some kind, another kind of investment environment. So moving into something and say, just keep it. If you can, live with it, then it will be fine to say, okay, I can live with a 40% decline in what could be gold, then you could invest in gold today and then say, okay, I can go through that for the next year or 2 years, and then I can see gold moving up to 15,000 or something like that. That would be great. And I think that if you're looking in that kind of time frame, then there will be, real estate, as you said yourself, and commodities and so on. I just do not think that we are at the end of that decline, and I think the decline in some of these commodities can intensify into that deflationary bust. We have to compare to the situation we had in 2008, from, let's say, March of 2008 until September of 2008. That was the time where we started to see the liquidity crunch, the credit crunch, and so on. And when there's no demand really in the system, and I know it's difficult again because it's 16 years ago, but when there's no demand in the system and the real economy is starting just to get into a free fall here, well, then you will not see a lot of commodities do well in that period. Then again, you can say, what about bonds then? Well, I think actually now you've seen, if you look at the ratio of SPX versus TLT, or you will actually see that there is what seems to be a new top there. And what I'm seeing from that is that we're potentially in a situation now where bonds could actually outperform stocks, or these large caps, the SPX, for the coming period here. And that means for the next, could be a year and a half. And that is quite, interesting to see. And but then again, at the same time, as we also just talked about, you could see crypto now moving up strongly. You could see small caps moving up, because I think what we're seeing there is not really the real fundamentals driving things. I think it's more of a FOMO. And if we now start to see easy money coming out, then on a shorter time basis, you will see that crypto and small caps could be, and I think Dixie will be moving down as well, you'll see these two asset groups actually moving up very strongly. So it's very difficult to say, what could I just buy today and hold for 2 years or 3 years and not seeing anything of it, decline, because I think that is the very problem here. That's the frustration that we stand with, that we will see ups and downs, and large ups and downs in some of these. So the timing of things and understanding why do we move from one scenario, and that's where your work is, was absolutely necessary here, because you will be able to start to see, okay, it seems like we're now seeing a bottoming of the inflation rate, which will be something I'll be looking for in my models to say, okay, that confirms what I see then in my lagging indicators, and that has a huge impact on whether we start to see a new business cycle emerging. So I think timing that will be where we look to the good work that you do, especially because you had made it more real time than just sitting and looking at very outdated numbers that like what the ones that we're getting tomorrow from the administration.
Yeah. No, I think so. We're going to be in murky waters, very wavy, tops and turvy, and we are going to just need to navigate that. There's nothing that's just sit back, put your money there, and have passive income. So we're going to need to stay abreast of things that are moving, and it's constantly going to be moving, especially around the election time, and we're witnessing that right now. But let me open it up. Rajat, you had a question. Can you hear us? Can you ask a question? And he is not asking a question or is not here.
Can you hear me, Stefan?
Yeah, I can hear you. Rajat, can you hear us?
Okay. I took the there's
okay.
Rajat. I took them off because I was gonna end the spaces. But go ahead, Rajat.
Hello. Hello.
Yeah, go ahead.
Yeah,
Rajat.
we can hear you. Go right ahead.
Hi. Good evening, everyone. I'm from India. My question is to Mr. Henrik. I've been following you for last 2 years. Actually, first question is regarding Indian markets. Like, do you follow Indian markets, or like as you were saying that major markets in the world have made their top? So, do you think about like same for India also? And second question is like right now we are hearing about this lot of market crash in the world from many people. So when everyone knows something, it usually doesn't happen. So if everyone comes to know that we are about to witness market fall in next 1 year, do you think that still it will happen? So these two questions, sir.
Okay, thanks for that. And you're absolutely right. Let me start out with the last one. I think it's when everybody's the one side of the boat, then you're normally in the wrong side. And so I totally get that. I don't think it's just about being a contrarian. That's not what it's about. Actually, I don't share your view on that, because I actually think if you look out in the more, you can say, normal bank amongst the normal bank experts and so on, and economists, you would probably see that most people expect that we have a soft landing. I think that is. I think maybe FinTwit is not, gauging that correctly. I'm not even sure that that's on what we see also on FinTwit. And especially, I also have to say that, Rajat, the moment we get to, if I'm right, on the top in the S&P, moving up to around 6,100, 6,300, then I think the last bear will be dead at that point. And that's why, so right now we are in a situation where we just had panic last week. And that's why I don't think you can really talk of that at this point here. And as I said, I think there's more upside in the US market. And then that leads me then to your question on the Indian markets. Well, I think the Indian market has had a fantastic ride for some years, and I don't follow them maybe not as close, obviously, as you do, but when I look at the structures that I look to, and also where I look to for the Nikkei, well, I start to see weaknesses in that structure, and I also did that into that. You had the long spike. I think it was around the election time, down lower, and then it just came up again, and even though it came up strongly, I still see that there are some momentum-wise weaknesses in that. And I find it difficult to see how India and any other country in the world would be standing strong in what I think is a very strong deflationary pressure and a large recession. So even though I hope the best for India and everybody else, I think unfortunately it seems like there will be a decline there also, and a large crash unfortunately also in the Indian markets. But is it right now and right here? I would give you that the Indian markets have proven to be stronger, and it actually than anticipated for the last few months here. But it's not the same as to say that it's things are just going to be great here. So, but let's see about it. And again, we don't want to be in the same side of everybody else, because then we're probably wrong.
Excellent question. Thank you, everybody, for your questions. Henrik, we've got a list here of questions. There are people online that want to ask you things. What I'm going to do is, because we have our spaces is recorded and I've already imposed upon your time here, I'm going to let you beg off. But if you have time, could you maybe look at the thread and when you find time, answer some of the questions in the thread here. Let you go. Henrik, how can we find your work and follow you and keep up with all things Henrik?
So I think the best and most easy way to simply just follow me on Twitter or X and at Henrik Zeberg, and then that's where I'll be interacting mostly with people. And I love to be challenged in any sort of any way that you can come up with. So please, if you have any good questions, please do it, send them. But I cannot promise to ask to answer everybody, because I obviously get a lot of questions.
All good. That, in my experience, was the fastest spaces I think I've ever participated in. I looked up and we're already into an hour. So you, my friend, can hold an audience. Thank you, Henrik Zeberg, for your time. Thanks to the panel. Thanks to our co-host, Stefan, for stepping in there and saving me. Everybody else, we've got a big day still ahead. We have the live stream here at 12 p.m. Eastern, where we're going to take on the Penn State collab that we did, a white paper that's really interesting. Something else we're launching. There's all sorts of things happening out at Truflation, so make sure you're following us here on X. And sorry to those who requested to speak. We just ran out of time. This went by fast. Thanks everybody again, and we will see you next time.
Yeah, thank you, Henrik, for your time and sharing your insights as well. And look forward to hopefully having you back.
Thank you for having me on today.
Thank you.